the Market Musings podcast. Welcome on to the Market Musings podcast here from Stockbox. Gervais Williams is my guest today. Gervais, it's really great to be speaking with you again. How are things? How's things been going so far this year for you?
Well, I suppose it's quite interesting, really. I mean, the old kind of playbook is that if you get uncertainty, markets react badly. We've had plenty of uncertainty this year, and markets reacted rather well, actually. So that's good news. Better still, actually, although clearly there's been a surge in AI and a lot of the technology US wonder stocks. But particularly, what's been interesting for me this year is you've seen many other parts of the market outperform, particularly income shares. You take the UK stock markets outperforming the US stock market. And of course, we've seen commodities, gold stocks, a good example of that, where we've seen gold stocks really producing much better returns than the US stock market. So I think the market's been quite interesting this year so far. And clearly, it's good that clients are making money.
It's definitely been a bit of a good year. I mean, we've had three sort of not great ones, haven't we, really? And I think if we had another one, i.e. 2025, as a not so great one, I think we would have seen, some quite big wounds, a lot of blood on the street. So it is good to see that this year has definitely been different. But it's definitely interesting, like you say, because, of course, you've got, Trump, you've got an inflationary environment. I mean, gold is performing well, but the stock market is also performing well. So, I mean, is it fair to say we've got conflicting signals here? I mean, is gold screaming a warning at us, or is it just time it's catching up with the reality of where it should be priced, do you think?
Yeah, I mean, I think there's just a general anxiety about the value of fiat money, the money created by governments. Of course, it can be a store of value, but they've been so willing to run such big budget deficits, it's kept economic growth going, very good from that point of view. But because they run such large budget deficits, I think people are getting a little concerned that actually the value as a store of value in money, cash on deposit is not as great as it was. So people are looking for assets to invest in. Of course, they can invest in the mainstream stock markets. US stock market's done well this year. We just talked about that. But I think there's an increasing interest in physical assets. Gold is a good example of physical assets. Right. I think quite a few central banks, particularly outside of the US, are holding more gold than they were previously, and they're not holding so many US bonds. But on top of that, I think we've also seen, price of copper, price of other commodities moving up. So I think there's a broader move away from cash into assets.
Into hard assets. Excellent. Well, that's good to hear, because we are quite mining and commodity heavy on Stockbox. I know London's also quite heavy in that space. So if that space can start to get some recognition, all the better. And I do like what I'm seeing as well. A lot of mining companies marrying that sort of digital asset with the sort of crypto element or the Bitcoin element in with hard commodities. We want to try and get some of that money and that sexiness from the crypto angle into mining, and I think that's really quite a good way of perhaps attracting some of that capital into stuff that is real and needed in the world. I mean, at some point there's going to be a correction, isn't there? I guess.
Of course. I mean, markets by their nature are spiky. They spike up beautifully, but they spike down too. I don't think people are expecting a setback shortly. So that probably means it's probably sooner rather than later. But as with all setbacks, hopefully they bottom out and things come back up again. You just have to be very careful to make sure that you can survive a setback, because the key issue is to be invested on a long-term basis. And if for reasons, you've got a geared position or something and you get clipped out of your holdings during a downturn, that means obviously you don't get the recovery potential. So careful about too much debt in your capital structures.
And are you positioning your investment portfolio with Premier Miton in that way? Are you a bit more defensive? Are you trying to hold a bit more cash, or are you just trying to not overexpose?
No. I mean, we do have some cash in the portfolios. That's just routine, particularly because we're investing in a great range of stocks where sometimes there isn't a seller, and then suddenly, three sellers turn up simultaneously. Lovely. We've got to have the cash ready to buy all three of those if they're happy to sell. Right, so we do keep a certain amount of cash back, not much. No, the main thing is actually we're probably not much. We're probably much more conservative in terms of economic growth. We're not expecting much economic growth. It's been better than people expected. As I say, budget deficits have been bigger than expected. That's led to more economic growth. CapEx in the AI market's obviously been enormous, and that's kept economic growth going. But aside from those two areas, if anything, we expect economic growth to be a bit more subdued. We think if you look at precautionary saving, particularly in the UK, we're seeing precautionary saving rising quite sharply at the moment. So we're not that upbeat about consumer stocks. We're certainly quite cautious about the mainstream sort of cyclicals. So where we tend to be invested across many financials, it's an area where people don't really like, and you can get some very strong financials. Certainly the banks have been very strong this year. On top of that, though, we've got quite a wide range of sectors, including things like mining, of course, energy. Yes, I know energy prices are low, but they are physical assets, and there may be a shortage of energy at some point in the future. We're quite happy with anything which has got some tangible some of the manufacturing stocks and such like. So from that point of view, we're quite widely spread, but most particularly we're spread in areas which most people find uncomfortable: complicated financials, mining stocks, right. Energy stocks.
Okay. Well, what I would like to do on this podcast is really try and do a couple of case studies, if we can, on two companies that I know that Premier Miton hold positions in. So Buccaneer Energy, formerly Nosoterra Oil and Gas, and ONDO InsurTech. And these are both companies that I'm pretty familiar with. They do come on Stockbox quite a lot to talk to the retail investment market. But I wanted to try and understand how someone like you and people in your team, first of all, recognize these opportunities. Secondly, try and value them as they are today. And then thirdly, see where the value perhaps could go, either that they're undervalued today or based on what they're saying they want to achieve in the future. So, I mean, Buccaneer Energy, if we can sort of start with that, because that has a lot of actual data points we can pull from. ONDO InsurTech perhaps has a bit less. But just to start with Buccaneer then, so just to set the scene, so it's a company that operates mature long life Texas assets, shallow declines. It operates at quite low industry break-evens, around $25 a barrel, all inclusive, I think, from what Paul's been saying to me on interviews. So they're really profitable at sort of $60 per barrel, which is obviously where we are now. Now, am I right in saying that Premier Miton hold, is it about 17.5%?
It's just over 20, actually. But it's unusual for us to go over 20, but this is a very, very small company. It's only about 2.5 million market cap. And a lot of people will say, hang on a minute, what's the point? There's lots of other energy companies which are 2.5 billion market cap. We don't have to go to this size. But the whole point about why our investment is, one, we want to invest in companies which are overlooked and have potential to go up. But most particularly, it's nice to have a company go up 30 or 50%. And we do have holdings which achieve that. And we're very happy for our clients when that does happen. But we want to give our clients a chance of actually investing in companies which go up 3 or 5 times. And my view is that Buccaneer has a much better chance of doing that than many of the £2.5 billion energy companies out there. And it's that sort of opportunity to have in the portfolio, which is the reason we hold this company.
Absolutely. I mean, it's much easier for a company to go from 1 or 2 million to sort of 3, 4, 5, 6 million than it is for a 6 million to go to even 12, to double from there. So I agree with what you're saying.
You could be mistaken for thinking that, with the US technology stocks, it's relatively easy at the big cap end. So we have seen some exceptions to the rule over recent years. But I fundamentally agree with your overall statement. It's much more common for businesses down the market cap range to achieve this 3 and 5 times. It's relatively rare for mainstream companies to do so.
Yeah, exactly. So first of all, how do you find such opportunities? Are you constantly scouring the market? Is the CEO approaching you? How does it come across your desk for consideration, first of all? Well,
the very first thing is that, as best we can, we want to be open-minded. You don't want to, if you say, I'm not going to meet that company, effectively, unintentionally, you've made an investment decision to not invest in that company. You're not reviewing it. You're not open to the potential. So first of all, I think the very first thing we would hopefully be different from many others is if a company wants to come and see us, we can't see them all. Of course, we'd love to see them all, but we can't. But most particularly, we try and give everyone, we can fit in a chance. So it's actually relatively easy to get a meeting with me. I'm very happy to open a meeting. A tiny company, it doesn't matter if it's big or small, it doesn't matter if the share price has been going down or going up, it doesn't matter if I'm bullish on oil or not bullish on oil. Let me have a meeting, and you meet the management team. We're very lucky in a way as fund managers in that many of the principals are very happy to come and see us. Many of those meetings are face-to-face. And within an hour, you can get a good understanding of the risks, the opportunities, the quality of the management team, and ultimately, the sort of foundations of an investment case. And of course, many of the companies we meet are perfectly good. They're well managed. but for various reasons, they don't tend to kind of tick our boxes. And our boxes really, more than anything else, are that we want a company where the management team are very engaged. Specifically, in a mainstream company, we want something where the service levels are high. It doesn't matter so much in Buccaneer, but obviously that's the general thing. We want engaged staff. We're interested in that, but ultimately we want the potential for the company to generate abnormally large cash surpluses. Buccaneer ticks our box beautifully on that regard.
Well, that's interesting. So there's two elements there I'm picking up on. First of all, the management, and secondly, the cash flow. So just on the management, first of all, that would be where I would align with you, so to speak, because I've been aware of what was Nostra Terra Oil and Gas for a while. But then when the new CEO, Paul Welch, took over, it was just over a year ago, maybe 18, 20 months ago or something like that, I did a podcast with him. And I really liked what he was saying. He sounded like a man who had credibility, who had a plan, who had a vision and was going to execute it. And given the fact that the company at the time was, I think, about £1 million market cap, it almost can't get much lower. It's almost shell value at that point. I do like a bit of a turnaround story, and I did like what Paul was saying. So that was immediately like a hook for me to like, okay, this is perhaps worth a bit of a go, just because of where it is right now and what Paul is saying. So is that a factor for you as well? Just did you gauge that from talking to the management, and you have to sort of make a good guess that this guy is actually genuine, has credibility, and is going to deliver what he says he wants to?
Yeah, certainly. I mean, we ask what we consider to be ready-to searching questions, so that does give us an opportunity to gauge, the how they make decisions and the attention to risk and how they address some of the more difficult issues they have to deal with. In this case, actually, we've been involved with our clients in SDX, which was another PLC, where Paul had been sort of prior to 2020. And we very much liked what he did in SDX. Unfortunately, for various reasons, he left SDX in 2019. But coming back to it, we already had a history with Paul. He had already impressed us in the past. And so when he got involved in Nostra Terra, of course, we were very delighted to meet him again. And very pleased about his plans in Nostra Terra, which I think, not in Buccaneer now, and the opportunity for Buccaneer to go forward. So we are aligned with you in that regard. Yeah, absolutely.
Okay, good. When it comes to actually looking at the numbers and that free cash flow, what is it you're looking at, and how are you making calculations? So I think at the moment, Buccaneer's worth about 2.5 million, something like that. Net production, I think, is around 140 barrels of oil per day. So we know the break even. So simple math says 140 times 365 times the net back gives around a $2 million revenue per year. So that's, I think, something we can, would you agree on that? That's something we can definitely
take on. No, I would start with that. And then you've got obviously the overheads and the costs. You've got obviously the need to invest. You need to kind of safety and obviously replace parts and all that kind of thing on top of all that. So I don't think the company is particularly profitable at this stage. It is it's just announced some losses actually. They had a lot of rain over the summer, so they had to lock in some of their production. So currently, when you look at just at the straight profit and loss account, you do see a company making losses. But the key for us is that they've got the potential to invest on very quick cash paybacks, so that they can extend the number of wells, bring new wells onto production. And as they do so, we think the cash payback on those investments will be very high, certainly less than a year. And if they achieve those targets, then the company can move from what is not a particularly profitable or unprofitable situation into a profit. So it can move from loss to profit quite quickly. And that's the area which is interesting to us.
So do you look at that revenue like we just talked about there, that 2 million? Do you then go further down and look at things like EBITDA and then free cash flow, taking into account the debt, that kind of thing? Do you go into those kind of details?
Yes, I mean, absolutely. I mean, the key issue is, in a way, not so much what's the last 12 months or whatever, but on a monthly basis, how much cash are they generating on a monthly basis right now? How much debt have they got? That's important. They do have debt in this case. They've got 4 million of debt. So coming back to it, this is an unusual position because we don't usually buy companies with quite as much debt as this case. But as they generate cash, and as you say, if they were to double production, sounds like a lot, but it's only 100 barrels a day. So basically, then you could suddenly find that they're generating an extra 2 million. That debt could be disappeared in 2 years. Now, of course, they've got to invest, so it may be taking us a bit longer. But coming back to it, you could have a company where the debt disappears very quickly. And as that happens, the market cap should actually reflect the debt which has disappeared. So on the off case, let's exaggerate and say the debt's disappeared in the next 3 years. The market cap of this should be, on that basis, something like 6.5 million. And our clients will have made 2 or 3 times their money. Very nice as a starter for 10. I think there's more Paul can do, which we can talk about in a second.
Yeah, okay. And I mean, at the moment then, would you say that Buccaneer is undervalued based on what we know at the moment? So not considering any upside, just where we are right now.
Well, I think we have to be, we're taking it, assumptions. We're making assumptions that the new wells he drills will be as productive as he hopes they are, and the production will come on stream. So that's a thing. Well, one of the problems bringing new wells on stream is that they do have gas, and it's not easy to flare gas. I don't think it's a good thing to flare gas, but it's certainly not an easy thing to do. So one of the reasons why actually the company itself is actually bringing in some Bitcoin hash miners into just a single container, it's a tiny little thing, is that they can use the gas to generate electricity, which then goes into their Bitcoin miners, which gives them a little bit of cash. But more importantly, much more importantly, it means that the oil can go into the, can come on stream, and they can increase the volume of oil, and that's where the cash flow is really going to come from. The kind of Bitcoin thing is a bit of a distraction, but it's an enabler for them to get more oil through the company.
Yeah, okay. So then when we look at sort of that doubling of production, like you say, so that would take the revenue to around, 4 million per year. And then that would bring them into profitability. I mean, I don't know how, is there a hard thing we can do to translate either revenue, free cash flow, EBITDA into a market cap? I mean, the market decides the market cap, doesn't it? So I guess there's always going to be some element of speculation on our part as investors as to where it could go.
Well, absolutely. I mean, we're all making assumptions all the time. So, does the oil price stick at $60? Does it go down to 40? Does it go to 120? I can't say. It's going to be a range. But what is nice from my point of view is that expectations for energy prices are low, and energy prices still could go lower. That's not saying they won't. But I like it when you start off with current expectations being low. Clearly, in a world of protectionism and nationalism and such like, even with the very good news we've got recently from the Middle East, it's still possible that people get grumpy with each other. Hopefully it's not going to turn into armed conflict, but there is going to be the room for embargoes and disputes and all of that kind of thing, trade tariffs, of course. So all of that stuff's just unknown out there. And it could be that actually the world is short of energy rather suddenly, and the oil price is not $100, it's $200. I'm not saying that's likely to happen. That's not my expectation. But the nature of investment in an energy company is you have this upside for free.
Absolutely, yeah, absolutely. So really, your key metrics here is the board, as we talked about, and the cash flow, the projection, what's happening now and what's coming in the future, and that's based on what the CEO is telling you that he wants to. I know Paul has bold plans, 1,000 barrels of oil per day in a year's time. I think in 3 years, sort of around 3,000, and his target is really 5,000. It's in 5 years' time. That's it's a big ambition, but he's stated that publicly a number of times.
Absolutely, and it doesn't matter if he only gets halfway there. I mean, not a problem. The share price will be multiples where it is now. So from that point of view, as I say, he has a very good history from SDX. He's been held back a bit over the summer by the extraordinary. They had a very heavy rain, but that's normal. This happens all the time, right? So is he progressing in the way I'd like to see him? Absolutely. Is the share price moved up? Yeah, not much, not a problem. It moved up some other time. But the risk-reward ratio, as you say, is that if he gets anywhere near his targets, then as investors we'll do very well out of this company.
Well, that's an interesting point you make there. I think you said you're happy with the progress, because I did want to come on to that, because of course there has been a number of placings, fairly large ones, and Perry Miton have backed that position every single time. So you've basically took some dilution, but then you've ratified that by taking part. So you are putting a lot of capital. You say it's unusual to put so much in there. I mean, 2 questions really. When it comes to the speed of execution here, are you pretty happy with the way things are going? Would you like to have seen things progress a bit quicker? And do you have to justify to anyone in your team, I mean, I don't know if you've got autonomy with the decisions you make here, to sort of justify an ongoing investment, constantly reevaluating if it's worth it?
Yeah, so I mean, we tend to run funds at Premier Miton in teams of two. So I've got myself and Martin Turner. We're both involved in the small cap fund where this holding is held. Absolutely, it's not down to me. It's down to us both. One of the things which is good about the team is that Martin meets many of the companies. Maybe I'm busy, or maybe he hasn't met Paul before. So from a coming point of view, is whenever they come in, they may meet me, but they may meet Martin. So every time they meet Martin, or if they've met Martin previously and they meet me, there's a degree of kind of like, we'll tell the story and justify in a position. What's very interesting is, although Martin and I are not clones of each other, we have different ways of, we've got different histories and different experiences. But most particularly, when it comes to meeting companies, we almost always come out with the same view. So we don't need to both go into all these meetings. If I come out a buyer or if I come out a seller, then the chances are Martin would have come out with the same view as well. So coming back to it, no, I don't have autonomy. Absolutely, it's myself and Martin. Of course, beyond that, we've got then oversight from various people to make sure that the liquidity is there and the portfolio balance is there, and that we're meeting the client's requirements in terms of the portfolio mix and all that kind of thing. So there are oversights on top of all that. So coming back to it, it's really about a mix of risks. The nature of risk is that, obviously in some cases you take a risk and it doesn't turn out as you want. So you need to have particularly a wide range of risks. I think the key feature about our UK Smaller Companies Fund, compared with most others, is I think we take a much wider range of risks in the portfolio. Some of them are risks which don't turn out well, but many of them are. And if we're lucky enough when they turn out well, to get a share price which goes up 3 or 5 times, then of course the fund does very well. And of course performance can come and go a bit. That the fund hasn't had a great 5-year period of returns. But if you look back in, when markets do turn well for small companies, and past experience is not necessarily a forecast of the future, but during the period in say 2020 when we had a global recession on, small companies were outperforming. The fund performed extremely well. And so we want to make sure we're not just there to make money for clients. Of course we are, but we really want to be there to make money for clients when things are going well. We want to make enough money for clients, and we've had a very strong history of making very good returns when markets are in our favour. And although share prices come down at other times, ultimately we've had we're not having to sell many companies because they've been failed. That we've made mistakes. There are some, but most of the company holdings in the portfolio are stocks which we liked 3 and 5 years ago, which we are still holding, and we're expecting much greater returns from them in the future.
Okay, and just on the speed of things, how they're progressing at Buccaneer, are you happy? Would you like to see things moving a bit quicker? I mean, personally, I think I would have rather have seen the Falk 3 drilled already, and maybe the plans for Falk 4 coming in, but maybe I'm younger and want more instant gratification. I don't know.
I too would have loved to see it. But let's just remind ourselves, they had extraordinarily heavy rain. The only reason it hasn't been drilled is because it's been raining so heavily that they couldn't get the rig there. Fine. We'll wait for the rain to stop and the rig to arrive. Am I marginally disappointed? Well, I'm sure Paul would have liked to have been drilling earlier, but we shouldn't be in any way blaming Paul for the weather. That would be a ridiculous thing to do. So, whether it's this month or next month doesn't really matter. What really matters is that hopefully it's the right well in the right place, generates an obscene amount of cash relative to the cost of the well, and that gives him much more flexibility going forward.
Good. And just a final point on Buccaneer. You've mentioned 3 to 5x a couple of times now. I'm not going to ask you to say what your exit strategy is, because I imagine that's very much an internal matter. But I mean, is it fair to say that's the sort of thing
I'm very happy to talk about exit strategies. If you want to. As I say, the key issue we're looking for when we invest is companies which generate abnormal cash flow. So we expect sales to grow, we expect margins to improve. Ultimately, we expect the management team to be very secure in its decision making, and we like to see a balance sheet which is improving as well. But also valuation. If this share price rallied very dramatically, of course we would sell it. So we call it the traffic light process. So sales, cash flow, margins, management team, obviously feet on the ground, resilient balance sheet, and then ultimately valuation. They can be green and red lights, and a single red light is a sell from our point of view. So many of our holdings we've had for many, many years. In some cases, we've had holdings which we had for very short periods. The share price went completely, surprisingly strongly, very, very quickly. It's not that we wanted to sell it in the short term, but other people wanted it a lot more. So we're very open-minded again when it comes to buying and selling.
Okay. Well, thank you. Let's move on to talk about a completely different company then. So ONDO InsurTech, for those who don't know, it's a water leak detection and prevention technology. It's a patented device that goes on the inlet pipe to a house. It can detect if there's a water leak. And then there is it warns the homeowners, and a plumber can come out and find and fix that leak before it causes sort of catastrophic damage. It's a big problem in home insurance, this water damage claims. But this is a company that there's not much data to grab hold of, and even at the moment they've got these trials running out. They're small trials. They're going well as far as I can tell, but are you more buying here into the product, like a Dragon's Den style kind of pitch, something that's quite a unique proposition, and valuing it? I don't know how you even start to value. I do love the company. I think it's a great company. I really like Craig. I like the product, and I think it's very professional, and it could go an awful long way if they make waves in the US, which is what they're starting to do. Maybe they can be taken out by a big US conglomerate at some point, NASDAQ listing, anything. But, what is it about, can we rationalize an investment case for ONDO, or are we looking here more at the sort of the concept side of it?
Yeah, I mean, we meet a lot of companies where they have a technology. Clearly, I'm not a technology expert. I'm not a coding. I don't code much, and obviously. But what I look for when I look at a company with a technology is for other people who've verified that technology. The whole point about many of the insurance partners, which LeakBot is used by, is that they would have had all sorts of technical experts crawled all over it, and they wouldn't have gone ahead if they hadn't been completely satisfied that the technology itself was very resilient and of value. So coming back to it, I mean, of course, they've had a huge range of customers which have gone through. They started in Denmark, as you know, so there's quite a lot of Scandinavian insurance companies. But what's been more interesting, really, over the last 12 and 24 months, really, is we've seen quite a lot of US insurance companies starting to use it. So they're at pilot stage. Some of them moved beyond pilot stage. But you've got, extraordinarily large companies. So you've got, take Nationwide, which is one of the largest insurance companies in the US. Not only has it sort of, obviously done a quick test, but actually it's now rolling it out to 25 states. So, and that's with Liberty Mutual, Nationwide, and a company called NMClaw. So what's interesting, therefore, is not just that people have tested it, not just that they've had some good experiences in their pilots in terms of feedback. And I think the Net Promoter Scores, we can talk about that in a minute, customers love it. But ultimately, the cash payback for these companies, and they're large companies, is sufficiently interesting for them to roll it out across the US free of charge. They give it to their customers free of charge. So coming back to it, that's why we have the confidence. It's because of the quality of the partners and the scale of the partners, rather than our own analysis ourselves.
And do you think that's fair to say that now then? Because one of the things I've been sort of asking Craig when I speak to him is, you've got these pilot trials going on right now. And I did sit down with Craig and someone from the NFU Mutual in Stratford recently. And they are working on the trial. And I was trying to get out from Craig that you're in a sweet spot now where lots of insurers are doing these trials. But they're going to have to justify internally to their bosses and their financial department perhaps a tangible return on investment. And that was one of the things that I think is a little bit
on. You're absolutely right. Absolutely. So, I mean, of course, there are a lot of the companies are a bit secretive about their trial data. Unfortunately, Craig isn't able to give all the details. He doesn't know all the details in certain cases. But if you take Top Denmark, which is one of the Danish insurers, they kindly, thank you very much, have given us a little bit of a flavour of their results. And they installed 10,000 units initially. They've moved to another 20,000 additional customers since. But most particularly, they reported in their trial, they got a 25% reduction in damage claims.
Okay.
So that's the kind of number which we're looking for to say, okay, so, given the cost of damage claims, the great reduction is enough for them to justify. And in their case, as I say, they've moved from 10,000 to 30,000 rolled out.
I actually didn't know that. Maybe I've missed that, but that's good then. So that's the Danish insurance company saying they've seen a 25% reduction. They're actually attributing that to the LeakBot. So that's good because, they're going to have to justify internally. And that's a battle for people who are supporting LeakBot in these insurance companies versus the finance department. And I was just wondering if Craig how Craig can work with those people to really help them understand that return on investment, because at some point they're going to have to say, no, we don't like it, we can't see the benefit here, or yes, we're going to go for a full rollout.
Yeah, again, it's data coming from the US customers, but LeakBot has said that they've got a return on investment of 188%, which obviously sounds like a good number. And they've saved 2.4 million of claims, $2.4 million of claims in the US. Again, that's their data. That's not third-party data, but that's still useful data for me. I like that, and I align that really with the customer service. So I'm very interested in Net Promoter Scores, and very kindly, some of the insurance companies have actually shared their Net Promoter Scores. So
they're good, aren't they?
Net Promoter Scores, as you know, they kind of, even a 0 score doesn't sound much, but it means that people scoring 9 and 10 in terms of service levels are matching those people scoring 6 and below. So, it's not great score 0, but it's not a bad score. In the case of Nationwide US, their current net Promoter Score is 87, plus 87. That's an extraordinary. We've got effectively nearly everyone ticking the 9 or 10 in terms of service box, and almost no one ticking the 6 or below. So that's incredible. Customer satisfaction 4.5. Again, we've seen some other kind of good thing, all sorts of feedback on the things. Mutual of Enumclaw, another US company, Net Promoter Score of 83, etc. So coming back to it, we are seeing some good scores. Of course, a few other companies are less strong. One or two of them are plus 36 or something. And it does depend a little bit on the arrangement. What we've seen in some cases is the insurance company have actually not just installed the leak bot, but they've sent around a plumber to make sure that all your leaking taps are also fixed, so that it's very sensitive to any extra leaks which might happen afterwards. And people love it. Yeah. They've got insurance a company coming in, installing the net, reducing the chances of their loft comes down because they've got an unknown leak in the loft. But most particularly, they also repair all the taps at the same time. You can imagine that's great news from the point of view of the customers, and engenders a longer term relationship. And again, Absolutely. It's not just the cash payback. But if you've got a customer who loves you and wants to keep coming back to you, again, that's real value add for the insurance companies.
So finally, how do you put a projected value or ROI on holding stock like ONDO InsurTech? I know Craig has said they're on track to be EBITDA positive next year. He said that a few times, so that means they're going to be getting that real revenue coming in that makes them EBITDA positive. Ting is a similar technology. It detects the arc strikes on an electrical, so it detects electrical faults. Do you look at comparators like perhaps Ting, or do you just look at this and say this is a unique proposition, it's got a very high net promoter score, I can see the ROI, almost the sky's the limit, particularly in the United States?
Yes, what I really look at is, the scale of Nationwide. Nationwide is one of the largest insurance companies in the US, as I mentioned. If it moves their needle, then you think, well, that's going to be useful. And then you look at all the others, which they've also signed up, as I say, a lot of Scandinavian insurance companies, a lot of other US insurance companies. So I say, well, on that basis, yes, the valuation isn't disgustingly cheap. We are talking about 48 million. Fortunately, we've held it for some time now. The share price has come up. Okay. An awfully long way. It is our largest holding. We love it, but because it's the largest holding, we've had to trim some. Don't get me wrong. Don't misunderstand what I'm saying. I'm not a seller. It's just we can't have unlimited amounts in individual holdings. So coming back to it, I think that the opportunity for this company to continue, it's probably 2 or 3 times from where we originally invested, to carry on going up is there because of the scale of the difference it makes to big companies. And that's how I really value it. And, these big companies, they're valued at billions, right? So, 1 or 2% to them is obviously, putting this share price up 25%. So yes, we think that this company could still be very considerably larger, and we think Craig's done a terrific job, actually, not just in terms of getting involved with the customers, keeping them closely informed, but actually I think he tells the story reasonably well, and that's quite important for investors as well.
Absolutely. And just finally then, with ONDO, for example, would you're going to be evaluating all your positions all the time, but would ONDO be perhaps more of a long-term hold, or again, is that just based on look at the ROI, look what our clients are saying, we'll make that decision then?
Yes, typically honest, it's share price dependent. So if the share price is 3 times the current share price, then we would probably be quite keen seller, but obviously, we still think there's still loads to go for. It's a very different risk to many others in our portfolio. We love that diversification, and specifically, the momentum's with it at the moment. So, you don't need to worry too much about, they may have a slightly slower period in a 3-month period, but generally the pattern, the usage is out there that the pilots have been rolled out. They're rolling out in the mainstream now, and there's great opportunity for them to sell an awful lot of leak bots. And as they get that installed base up, then that's what's going to really drive that cash surplus, which we look for all of our quoted companies.
Excellent. Gervais Williams from Premier Miton, thank you very much for your time today.
It's been a pleasure. Thank you very much for the questions.